Welcome back to AlphaIndex, where we explore the hidden wisdom behind online money-making and intelligent investing. Today, we're tackling something many people shy away from: the language of investing itself. You've heard terms thrown around EPS, P, market cap, and perhaps felt a twinge of inadequacy, thinking you needed a secret decoder ring to keep up. But what if these terms aren't just arbitrary words? What if they are signposts, pointing to fundamental truths about value, growth, and risk? What if understanding them isn't about memorizing definitions, but about grasping the underlying principles they represent? Today, we're not just defining terms, we're illuminating the principles behind them, giving you the clarity to navigate the investing landscape with confidence and true understanding. Forget what you thought you knew. Let's unlock some profound insights. Let's start with market capitalization, or market cap. You'll often hear it when discussing the size of a company: a large cap company, a small cap. But what does it truly tell us? Principle. Market cap is simply the total value of all a company's outstanding shares. It's the collective belief of the market in what that entire enterprise is worth right now. It's not just a number. It reflects the market's current consensus on a company's past achievements, present strength, and future potential. A high market cap often suggests stability and broad influence, while a lower one might indicate a nimble innovator with explosive growth potential, or perhaps a struggling entity. Understanding market cap helps you contextualize a company within the broader economic ecosystem. Next, earnings per share, or EPS. This is one of the most frequently cited metrics. Principle. EPS breaks down a company's total profit and attributes it to each individual share. Think of it not just as a financial metric, but as a measure of a company's efficiency in generating profit for its owners, the shareholders. A rising EPS, particularly consistently over time, signals a company effectively growing its profitability and, by extension, growing the intrinsic value of your ownership stake. It's a direct window into the company's ability to create real wealth. Now, perhaps the most famous, or infamous, the price to earnings ratio, or P/E ratio. Principle. The P/E ratio is not just a number. It's a statement about market sentiment and future expectations. It tells you how much investors are willing to pay for each dollar of a company's annual earnings. A high P/E often suggests investors anticipate significant future growth, or that the market perceives the company as a high-quality, stable investment. A low P/E might indicate a mature company with slower growth, or perhaps a deeply undervalued gem. It's a crucial tool for understanding the market's story about a company, its hopes, its fears, and its projected trajectory. Let's talk about dividend yield. For many, this is the sweet music of passive income. Principle. Dividend yield represents the annual dividend payment as a percentage of the stock's current price. It's the tangible return you receive just for holding the stock, beyond any capital appreciation. But it's more than just income. It speaks to a company's financial health and its commitment to returning value to shareholders. A consistent, growing dividend yield often signals a mature, stable business generating reliable cash flow. It's a fundamental principle of compounding wealth through consistent distributions. Moving on to volatility. This term often evokes fear, but understanding it transforms fear into strategic awareness. Principle. Volatility measures how much a stock's price fluctuates over a period. It's not inherently good or bad. It simply describes the degree of price movement. High volatility means bigger swings, which can offer greater potential gains or losses. Low volatility suggests a more stable, predictable asset. The principle here is about risk assessment and temperament. Are you investing in something that will keep you awake at night, or something that aligns with your capacity for market fluctuations? Volatility is a measure of the market's emotional heartbeat around an asset. Next, diversification. This isn't just a buzzword. It's a bedrock principle of risk management. Principle. Diversification is the strategy of spreading your investments across various assets, industries, and geographies. Its underlying principle is simple. Don't put all your eggs in one basket. It's about mitigating individual asset risk. When one investment struggles, another might thrive, smoothing out your overall returns. True diversification isn't about owning a little bit of everything. It's about owning things that react differently to various market conditions, building a portfolio resilient to the unpredictable nature of the future. Hand in hand with diversification is asset allocation. Principle. Asset allocation is the strategic decision of how you divide your investment portfolio among different asset classes like stocks, bonds, real estate, or commodities. This isn't just about picking good investments. It's about designing your portfolio to match your risk tolerance, time horizon, and financial goals. It's the architect's blueprint for your financial future, a proactive choice that dictates the very structure and potential outcomes of your wealth-building journey. It's about aligning your investments with your deepest financial intentions. Now for a term that represents perhaps the most powerful force in wealth creation: compounding. Albert Einstein reportedly called it the eighth wonder of the world. Principle. Compounding is the process where the earnings from your investments are reinvested, generating even more earnings. It's earning returns on your returns. This isn't just a financial term. It's a profound principle of exponential growth, not just in money, but in knowledge, skills, and relationships. In investing, it means time is your greatest ally. The earlier you start, the longer your money has to grow on itself, turning small, consistent efforts into monumental results. It's the ultimate hidden wisdom for long-term wealth. You'll frequently hear about bull markets and bear markets. Principle. These terms describe the overall trend of the stock market. A bull market is characterized by rising prices, investor optimism, and economic growth, a period of expansion. A bear market is defined by falling prices, investor pessimism, and often economic contraction, a period of retreat. But the deeper principle here is about understanding market cycles. Markets are inherently cyclical. Recognizing whether you're in a bull or bear phase helps inform your strategy whether to capitalize on growth, protect capital, or seek out undervalued assets. It's about reading the collective psyche of the market. Finally, and perhaps most crucially, intrinsic value. This is the North Star for true value investors. Principle. Intrinsic value is the actual worth of an asset or company, independent of its market price. It's what you believe a company is truly worth based on its fundamentals, its assets, earnings, future cash flows, and management quality. The market price is often swayed by emotion, hype, or fear. Intrinsic value is an anchor in the storm, a calculated assessment based on reason. The wisdom here is profound. Invest when the market price is below your calculated intrinsic value. This is the core principle of intelligent investing, buying assets for less than they are truly worth, thereby building in a margin of safety and a pathway to genuine wealth. So, there you have it. 10 terms that often intimidate, transformed into 10 guiding principles. You see, the language of investing isn't designed to keep you out. It's a framework for understanding the mechanisms of wealth creation, the ebb and flow of value, and the true meaning of smart money. If you found this demystification helpful, do me a favor. Share this video with a friend who's looking to start their investing journey. And if you want to continue building your knowledge, remember to like and subscribe to AlphaIndex. We have new wisdom coming your way every week. Thanks for watching, and I'll see you in the next one.